Hey guys, how you doing? Top news story here today. Doing a little bit of research about the new moratorium that Biden is going to continue to do. And guys, us as investors, there's nothing we can do to control that. But what we can do is prepare for what may be coming. I was just reading through some statistics, and according to the article I read, 12% of people are late on their home mortgages. 10 million homeowners are behind. Now, to keep that in perspective, there's only 80 million homeowners in the United States. Yes, there's 330 million people, but there's 80 million homeowners. So that means 1 in 8 people are behind on their mortgages. And maybe I'm naive, but I guess I am. I haven't even thought to ask my brother or sister or anybody in my family if they needed help. Because to me, it's much like when you're poor. When you're poor, you don't know there's a recession. And when you're wealthy, you don't know there's a recession. You're just living. Like I know when I was a kid and we were poor and somebody would say, man, the stock market's falling. We like, man, nobody got stocks, man. Who cares? You know? I mean, it was still, you were poor. You were still eating peanut butter and jelly. Everything was the same. And then so when you make a lot of money, there begins to be more opportunities that you see open up. So what I want you guys to understand is the last real estate cycle, I went bankrupt though. I was one of the people that got ate by the cycle. And I vowed that I would not go through that again. And so I diligently learned and studied. Probably was almost obsessed with knowing everything about every situation that could possibly happen. So I was prepared because I now had a family to take care of. So there's 138 million households. 80 million of those are homeowners and 10 million of those are behind, guys. So what does that mean for people who own real estate like me and you? Well, I remember when I went through the last cycle, there were a lot of people that lost their properties. And what happened was they turned into renters. A lot of these people had, as the market started coming back, they had jobs, they had the income, but they didn't have a credit. They couldn't get housing. So I think what's going to happen if that happens again, guys, we're going to see a further crunch of people migrating back to rental properties, which we already have a shortage of. So it's simple, guys. It's supply and it's demand. I think the stuff at the top end of the spectrum, if you got big, expensive, apartments or houses, those ones could suffer because those ones, there's not a lot of people up there. But the ones where, 80% of the people are going to live, and between that probably $700 and $1,500 a month payment, those are the ones that I think are poised to do really well through a recession. And guys, I want to be real clear. I don't want anybody to suffer. I don't want to see a recession, even though you can make a lot of money. I don't, because I think about all the people that can be affected. But what I want to do to you is I want you to think about a few things that's happening right now. Number one, we're at the end of a long-term debt cycle. And so look, guys, I want to tell you a little bit about what I've been studying, me and my partners, and what is more than likely happening right now. A lot of you guys probably never heard of a short-term debt cycle or a long-term debt cycle. We are at the end of both of those. So here's what happens, guys. Look at this chart. See how this goes up and down and up and down and up and down. Can you see that? So what happens? You have these short-term debt cycles. So let's say the economy's doing good. The government comes in and they try to raise interest rates to get a little bit of that back. Then the economy pulls back a little bit. See, they want to control inflation. They want to keep inflation at 2 to 3% a year. So when the economy starts to correct and pull down, what they do is they drop the interest rate, stimulates the economy. Everybody goes and refinances. The cost of funds get cheaper. So you're able to afford more money on your house because your income grew a little bit. And now you can buy you can afford a $250,000 house instead of a $200,000 house for the same payment. So your house values go up because everybody's not looking at how much money they can pay for a house. They're looking at what their monthly payment is. So that pushes up the value. They're able to push more credit out. And this cycle continues to go on. And what happens every time you go through 7 and 9 years, you go through a short-term debt cycle, which is your recession. So you go through a recession, the government drops interest rates, pushes it back up, stimulates the economy. Well, what happens about every 100 years is called a long-term debt cycle. That means that the government has ran the interest rate all the way down to zero. They can't lower rates anymore to stimulate the economy. Why is that important? Because that's where we're at right now, 2021. Let's look at the 10-year treasury is at like 1% right now, meaning that you can't really drop rates anymore. Maybe a half a basis point. Maybe 50 basis points, which is a 0.5%. You can even take it to zero, but it's not going to move much more at all. You can't create much more value. So why is that so important? The government uses that to grow our economy. So now that they can't do that, we have all this debt. Nobody's even buying the bonds. The Federal Reserve is buying the bonds. The Federal Reserve is not even owned by the federal government, guys. It's no more federal than FedEx. It's owned by a private group of individuals. And, our balance sheet that the feds are holding has grown from $4 trillion to $7 trillion in 2020, maybe more, because nobody's buying bonds. Why would you buy a bond that's paying 1% when inflation's 3%? It means you're losing 2% of your money. So what the government is looking for right now is inflation. So how do you combat and hedge inflation? A lot of people buy gold, but I don't like gold. See, gold just sits there and it's shiny and it's pretty. Don't get me wrong, I got a gold watch, but it doesn't really do anything. This thing tells time. I don't need this thing to tell time. I got a clock. It's for fashion. It's for, it just doesn't really do anything. It doesn't bring me in money. It doesn't have any passive income. Now, the cost to build Rolex watches is continuing to go up, and that's what drives up the market for used ones, much like housing inventory. So when you build a new house and it costs a lot more than an old house, that drags up the value. So, guys, what we need to prepare for is inflation. Inflation is great if you own a lot of properties. If you don't own any properties, man, it's not a good thing, man, because your buying power, even though you may think you're getting more money, they give you a raise to $15 an hour, you don't really have any more buying power, because now you go and, your landlord, instead of charging $900, he had to pay everybody more money. Now he wants $1,100. So your extra, let's say $3 an hour you got for 40 hours a week is $120. Your rent might have went up $200 for the month. So you had another $480. Now you're in a little higher tax bracket, so you're only bringing home $350 more of that. Maybe $300 of that. $150 of it's ate up in rent. Now go to McDonald's, $8.99 for Big Mac meal. Go to movies, that costs more. Everybody has to get paid more. So your buying power is lower, but properties can go through the roof. But why does the government want inflation? Because they can't stimulate the economy anymore through lowering interest rates, but what they can do is create inflation. See, the government makes their money off of GDP. That's gross domestic product. So it's kind of like our income. So if they can push the GDP, not through producing more goods and services, but make everything worth more money, then let's say they can push it to a $30 trillion GDP, which they can and they will through inflation. And they tax that at 30%. 30% of 30 trillion is 9 trillion. Right now, let's say we're sitting at 22 trillion. 30% of that is 6.6 trillion. See, they just gave themselves a raise. Then they borrowed the money. They pegged the bond rate at 1%. They let inflation run at 6%. 6% compounded over 4 years is 27%. 1% compounded over 4 years is like 5%. They just wiped away 22% of the federal deficit in 4 years by creating 6% inflation compounded on each other. So, guys, what does that mean for us? It doesn't mean doom and gloom. It means you need to be prepared for what's about to happen. You need to own real assets. You need to own microphones. You need to own water. No, you need to own real estate. Real estate is a hedge against inflation. And guys, I've studied this stuff over and over and over again. And guys, don't think that our country hasn't been through this. Go and look at the debt to income, or go look at the debt to GDP ratio chart. Matter of fact, let me pull it up for you. I want to show you this before, guys. Debt to GDP, US, and the 1940s, okay? And we've already been through this before. Our debt to GDP was up there where it's at right now. And you want to know how they got out of debt? Inflation. They let inflation run rampant. Look at this, guys. See this over here? They were at 120%. And look at this. Our debt to GDP dropped. How did they do that? It dropped all the way down to 40% when it was at 120. They didn't pay it back. Here, let's go back and look and see what they did. Look at this. The debt by year. Look at this, guys. The debt to GDP 1946 was 118%. 1947 was 103%. And look at this, guys. It kept dropping, even though our GDP, which is this column here, this is the debt. This is the debt to ratio. The debt kept going up. It kept climbing. So let's look at 1950. It was 257. In 1960, it was 286. But look at the percentage drop. It was 53%. 1970, it was 371, but it was 35%. They outgrew the debt, which it's like you having more income. If you go to the bank and you have more income, even if you got the same debt, you can keep borrowing money. So that's what they have to do right now. And I want you to prepare for it. Follow my videos. Go to YouTube. I'm going to show you all this stuff that I think you should be doing, and you can create massive wealth. Let me tell you something else. I'm a car guy. And someone on TikTok, man, was funny. They said, showing kind of some of my cars, and it was like, man, I bet he can't fit in them. And then I was like, man, he's right. This is kind of hard getting in that Lamborghini and Ferrari, and Viper's really hard because that door comes in. But I can still get in them. And so I'm just kidding, guys. But man, TikTok's funny, man. They said I was, what they say I was, Matt? The Walmart Ben Mala. I don't know if you guys follow Ben Mala, but he's hilarious, man. And so that was a compliment. That was a compliment to me, man. I appreciate that. I'll drink to that. So, guys, what inflation means if you own property is you're going to lock in long-term debt, 2 or 3%. Your rents are going to climb because everybody's going to need more housing. The cost of housing is going to go through the roof. The value of your house is going to go through the roof. And so, like I said, I'm a car guy. If we go back and we look at, I'm going to show you guys, 1979 Corvette. See, we were in massive inflation, and I could go on and on and on and tell you why. I could tell you about the petrodollar. Let's see, MSRP. Look at this, $10,200. You could have got you a brand new Corvette. What do you think that Corvette cost? And let's say 1984, 5 years later. Look at this, guys. By 1985, a Corvette was $25,000, up from $10,000. So 6 short years later, that thing shot up. You see it right there? 1985. There were 39,000 of them produced. Who the heck could afford them things? I'll tell you who. All the people that made all the money off real estate. A lot of them guys made a lot of money because inflation went up. Everybody going to buy them a new Corvette. So, guys, I'm telling you this because I want you to be prepared for what's coming. We have 81 million millennials out here. We have 78 million baby boomers, and we're coexisting together. And I am a Gen X, and I'm squeezed in between. Matt over there, he is a millennial. And you guys are, a lot of you guys are just very, very, you think different. You don't care about money as much. And, man, I applaud you for that, man. So give your guys a pat on the back because you guys do what makes you happy. You don't have the same fear that I think the baby boomers had about not having money. And my generation were just kind of, I don't even know, man. We were like lost. It cost a lost generation. I'm still lost. But you guys go back, man, and just watch my videos. I want to set you up for success. I wanted to show you how you can make hundreds of millions and billions of dollars through this coming recession that's coming. And I don't know when it's coming, but I know it's coming. They always come, guys. They're short-term, and short-term debt cycles, that's a recession. Long-term debt cycles and short-term debt cycles meet, which is where we're at right now. That's the last time we had one was 1929, 1930. The Great Depression, guys. So there's no more, the feds don't have any more ammo in their gun as far as lowering the interest rates to spur the economy. So there's only one way out of this inflation, guys. So go get your ammo. That's our houses. Go get your apartment complexes. Go get your bricks and mortar. Go ante up. And just remember, when you do make all this money, there are people that struggle. Just give them back. And that's why I'm giving back to you guys, because I want you to succeed. Make sure you hit the like button, subscribe, click on the bell. We're going to give you notifications. Watch my next video. Make sure you hit the like button, subscribe to our channel, Nate Barger on YouTube, and hit the bell, and you'll be notified on any new videos that come out.